Looking at the main market over the past trading session, we can see across the board the stock market did well. Tesla rebounded. All sectors came up 1.8%. Consumer discretionary did the best, followed by energy and information technology. The worst sectors, healthcare, real estate, and consumer staples. As expected, rates were held exactly where they were. And the Fed, using their Fed speak, basically said, "We're waiting on the data. We'll have to wait." But when we look ahead to the 7th of May meeting, we're already seeing a probability of a rate decrease of 20.5%. There is currently extreme fear inside the main stock market, with a 22 reading. When we look at the timeline, that's actually improving. The fear is coming out of the market. Green days will do that. This signifies red days. This signifies green days. The question is, are we about to turn around and rock and roll up to new all-time highs, or is this just a fake out and we're going to go lower? Let's look into that question and let's run the numbers. One thing to keep in mind, over the next 5 to 7 years, Bitcoin will overtake the market capitalization of gold. It will move from a $1.7 trillion asset class in excess of $20 trillion. When that occurs, the expectation is that Bitcoin will be trading at in excess of $1 million per Bitcoin. Where you buy definitely matters. What you can think about is something like this. If you bought here way back, in 2020, you were buying at around $10,000. When the price of Bitcoin came down to $4,000, you would probably likely sell and think this thing is going to zero, only to see it turn around and go literally up to in excess of $60,000. Many investors believe they are not traders because they have a long-term mindset, but the reality is anytime you buy or sell an asset, any asset, you're making a trading decision. Whether you're holding for 10 minutes or 10 years, most investors ignore short-term price movements, only to realize way too late that they bought at unsustainable peaks or sold right before the major reversal. What you want to focus on is entering and exiting at optimal price points, rather than leaving your timing to luck. This is a picture of the S&P 500's chart at around that same time. You can see the C19 sell-off and where it just plummeted down to. But there was so much injection of liquidity, it quickly recovered. The question is now, is this a dead cat bounce or a reversal to the upside? You can see that I have an indicator down here. This indicator is from the Profiting from CTKS Method structure, and basically what it does, it measures particular oversold or overbought levels. What we can see here, we're dramatically oversold at the current time. And if we look back to past market cycles where we encountered that, what did it look like? Well, pretty much near the bottom, near the bottom, near the bottom, not quite at the bottom, but near it. Here, nowhere near it. The bottom took quite a bit of time to play out. And in C19, when the entire world shut down, we were nowhere near the bottom then. One of the things to note, if you were properly prepared for this market sell down and you knew the structural levels to buy, you would do incredibly well buying something under the 10-5-10 rule. Now, what does that mean? If something is $10 and you buy it for $5, that is a 50% decrease. But from 5 back to 10 is a 100% increase. It's not a 50% increase. Now, what does this mean? You literally want to buy for as low as you can go. Now, do we expect something like this, or do we expect something like this? That is the major question, and the way that you answer these questions is to look at structure. Looking currently at the S&P 500, we can see that it's been in one hell of a downtrend. Let's put some more accurate lines on this. What we can see when looking at the S&P 500 is that it's literally starting to get to a level where it could overcome and change the trend, but it realistically needs to get up to around that 5740 mark until we can say things have changed. Right now, we're only witnessing a retracement to a normalized price path in a way. The difference between our channel and literally every other channel is that we just tell you the facts. We don't tell you a story. You get your stories from the mainstream media news. We look at structure. To understand retail sentiment, we need to look at a slightly different perspective. We need to bring in the moving averages. One thing that we can see on the S&P 500, the 200-day moving average is right up here, and it's been rejected the first time and the second time. What it basically means is that retail only looks at moving averages, Bollinger Bands, Fibonacci retracements. They don't look at structure. But many people think that they actually look at structure, whereas they're just drawing up something like this. This is not structure. Structure is drawn through all of price history, not just a little bit. Just to explain it a little bit further, these candles, this pattern that's playing out is across 26 days. When we take 26 days and we divide it by the number of periods of open price action, let's just assume they're 55,000 days, 55,815. What we get as a percentage is less than 0.5%. Imagine driving your car and you could only see out of the windscreen 0.5%. You would crash. But this is exactly how retail investors and traders look at price charts. We do not look that way. We draw up through 2 levels of standard certification across all of price history. But the key is you must know what retail is doing and what they're thinking. They'll basically think as soon as they've passed the 200-day moving average, everything is fantastic. It couldn't be further from the truth, and it's utterly irrelevant. That's why it's important, incredibly important, to understand where the structure is. You can see right now on the S&P 500, and I'll just turn off the moving averages there, you can see around these areas there's overhead structural resistance, and that's what's been causing the price of the S&P 500 to retrace. Now we do have light support here and light support here. We're getting into heavier support, but as soon as we do something like this, it reconfirms a downtrend. So we don't want to see these lower levels activating. Now, what does it mean? It means that we get above 5,700, and if we can convert this overhead structural resistance, and this is drawn from all of price history, if we flip that from resistance into support, fantastic. The key level is 5,700. Unlike others, you know, they're guessing. We don't guess here. One of the best risk-on and risk-off indicators is undoubtedly Bitcoin. Let's just have a quick look at zooming in on Bitcoin's price structure. Now, what we can see, we had a cut under here at the start of March. Now, that cut under created a lot of negative downside price action. Again, we're going to look at structure, but it's important to understand the basic trends. And when we look at this trend, is Bitcoin in an uptrend? Undoubtedly not. It has to get above 90,000 to even confirm the possibility of an uptrend. Where is an uptrend actually established? It's established above 100,000. This means that if you're an investor, you're probably an emotional trader. You will get pulled in when the candles go really bright green, and you'll get pushed out of the market when the candles go bright red. But we think in a completely different way using the CTKS method. We have an investment bag and a trading bag. We can take advantage of upswings and downswings in volatility, and remember back to MicroStrategy, and congratulations to Tails of the Man Cave, who said he was riding that positive and negative CTKS gap. And thank you to everybody for your awesome comments in yesterday's video. We just have the most amazing community. Now, the thing that I want to point out here, even though Bitcoin is heading to $1 million, you want to buy correctly. Unfortunately, many people bought around the 108 level only to see things crash down to like literally 76,000. That is a very painful journey. And of course, as Bitcoin is crashing down, the alts are bleeding 3 to 1 in terms of percentages. The reason for an investing bag is to add. As everything goes really negative, you want to add in those times. And your trading, you're always seeking to enhance and increase your timing capability. A lot of people go all in and more at one particular stage, and they just sell when there's capitulation. In other words, the pain just becomes too great. And then what typically happens, people get literally PTSD. They start to question themselves, they start to question if they've got the skill. Now, in times like this is just a rite of passage. Having been inside financial markets for nearly 40 years, I can tell you this is normal stuff. This is an average day. It can be really hard to take, but it's just normal. And you'll learn to disconnect from these big green candles, and you'll start to connect with structure. You'll throw away all the news narratives of all the things going to the moon and going to zero, and you'll just simply say, I need to get independent from the news. Why? Because the news always pulls people in when it's going green and pushes people out when it's going red. Why do they do that? Well, hint hint, it's not for your benefit. The CTKS method is all about getting rid of the emotional roller coaster and replacing it with knowledge, systematic systems that can help you to understand where the safety nets are and where the ceilings are, where things are likely to rebound from and to. With that, let's look a little bit more deeply into Bitcoin. Now, what is retail going to do around a time like now? It's going to get all excited. Look, we've overcome the 200-day moving average. Throw the party. Yeah, not so fast, people, because there's a bit more to go. In fact, there are 3 levels and an absolute basic minimum that must be overcome to re-establish an uptrend. And I mean an investor's uptrend. Traders don't give a hoot about uptrends or downtrends, especially using the CTKS method. We can take advantage of volatility to the downside and to the upside, going long at spot and not using any leverage. Okay, so what we're seeing is that retail will get increasingly excited. It's going to be parties all over the place, no smashing of computers. Memes, they're not going to be coming out right now. It's going to be something entirely different. Don't get caught up in the hype. Let's have a look how structure works. What I've done here is to combine CTKS lines, which are also called Stanfield levels, into SCs or Stanfield zones. These particular shaded areas show you where the accumulations of structure are. If we go back inside the past 48 hours, we see that the stock market, the S&P 500, even though it rallied in the past trading session, it came down rather hard. It found structural support, and in this past trading session got above this structural once resistance level and is seeking, and I mean seeking, it's not yet confirmed, this as support. Now, if it can't hold as support, it's going to have negative structural attraction back to this area of structure. And we understand these structural zones and these specific levels in advance. What typically happens with candlestick pattern analysis, you have to have the candles to play out before you know where the structure is. That's kind of a big problem that the CTKS method overcomes. We know in advance where the structure is for the month. Now we know that the S&P 500 is simply retesting an area of resistance in terms of short term. If we start to hold here, we must challenge upper levels of resistance and get across them. The only difference between us and pretty much everybody else inside financial markets, we know where the structure is, how strong it is. If you want to look back at yesterday's video, take a look at MicroStrategy. It's a doozy to understand. And those swings within strategy, not MicroStrategy, but in Bitcoin strategy, were severe. They were 25% plus swings. All you realistically need to do, now just popping across to Bitcoin, is to understand where the retail sentiment is, and it's quite positive at the current time. We've seen the 200 period moving average, or the 200-day EMA, get tested and bounce from. So all the TA analysts out there will basically say, it's all fantastic, the 200-day moving average held, so therefore it's party time. But we know it's a little bit early to confirm that. Instead, we need to look at structure, because structure will tell you literally everything. One thing that you can see right off the bat is that there was structure around. When the price was here, we had a positive CTKS gap, and 85,728 up to 86,120 were structural resistance levels. We can see that the price of Bitcoin, and this is on the 30-minute chart, has managed to get above here right now. What you will find is that when you have periods of structure, you'll typically get tap backs into this area to either confirm it as structural support, and you'll see those kind of bounces incoming, or deny it as structural support and turn it into structural resistance. This is literally a completely different way of looking at financial markets, because you already know where smart money is going to buy and sell. We saw that there was a lot of overhead structural resistance playing through this particular area, but now we're starting to see positive price momentum. But if you zoom out, you realize that Bitcoin is only in the starting process of turning around. It has quite a bit of leeway in it. Now, what this particularly means from a trading perspective, you can do incredibly well from any up and down price movement. From an investing perspective, you must be aware of what retail is looking at and where the structure is that either supports this or denies it. For example, retail would only think the structure is right there on some mythical 200 period moving average of price. The problem is a simple moving average, and this is coming from my background as a lecturer in first and second year statistics. This doesn't account for anything. Price is exponential by nature. It's always imploding and exploding, and anybody who understands statistics understands that standard deviation gets biased when the variability around the mean increases by orders of magnitude. In other words, if there's exponential price action, standard deviations and averages mean pretty much nothing. This is just a helpful guide given by institutions to retail traders and investors. Bitcoin is definitely going to $1 million per Bitcoin. But that doesn't mean we should go all in and more, especially when we see a green candle, even a really big green institutional candle, because they're often reflected backwards. Everything depends on structure. And when you come up to an area of overhead, internal structural resistance, you've got to be aware of how smart money can manipulate price. Whilst everybody else is saying the bottom is in, it's only up, everything is fantastic, you can just zoom out a little bit and say, what are these people smoking? Yeah, they're smoking hopium. You don't want hopium, you want to make money, and you don't get money by being, misinformed. What you simply need to do is to have a very simple structure that you follow, a very simple process or method. If it's getting above an area of overhead structural resistance and confirming it as support, it will go to the next area. That's called positive structural attraction. But one thing to note, if it doesn't confirm, it can come back to a lower level to seek to find structural support there. And these lines here are not structural. These shaded areas, they are structural. When you're looking at a moving average, you're basically seeing a couple of lines that tell you absolutely nothing in real terms. You've just been conned into thinking that they're somehow significant, but people coming from statistical backgrounds understand exactly the limitations that these particular retail indicators have. Now, what does this mean as an investing strategy? Well, you should always be holding a portion of your funds as dry powder to take advantage of any downside momentum and movement. What you want to do is to buy on red, and especially if you've got also a trading account, and the trading account is designed to teach you timing. Traders must time the market. Investors think that they can just buy anywhere and everything will be good. That's not the case, and it never has been the case. There is a very specific way that we can look at price action to understand in depth what retail will not see. And you must have an edge inside financial markets. This particular video is just helping you to understand that while Bitcoin will go to $1 million, if you buy it lower, you can do incredibly well because your percentage gain will be much greater. And the thing is that most people are not investors, they're emotional traders. They will buy when everything looks like it's going to go to the moon and sell when everything dumps on them. And they'll just keep on doing that again and again and again until their account is whittled down to PTSD levels. You must do things differently. I mean, if you want to survive inside financial markets and you want to do well, and that's what our whole community exists to do, to look differently. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.